Tariffs are essentially taxes on imported goods. They are designed to make foreign products more expensive. This encourages consumers to buy domestic alternatives. The goal is to protect domestic industries and jobs. However, tariffs can also lead to higher prices for consumers. They can also spark retaliatory tariffs from other countries, hurting exports. The use of tariffs is a contentious issue in international trade. Proponents argue they protect domestic jobs and industries. Critics argue they lead to higher prices and harm consumers. The impact of tariffs on the economy is complex. It depends on a variety of factors, including the specific tariffs imposed and the response of other countries. The Trump administration imposed tariffs on a wide range of goods from several countries. The most significant tariffs were levied against China. These tariffs began in 2018 and escalated over time. The tariffs targeted a vast array of Chinese products. In addition to China, the Trump administration also imposed tariffs on goods from Canada and Mexico. These tariffs primarily targeted steel and aluminum imports. The tariffs on Canada and Mexico were met with retaliatory measures. This further escalated trade tensions between the United States and its North American neighbors. The imposition of tariffs by the Trump administration coincided with a period of significant volatility in the stock market. The market experienced sharp swings in response to tariff announcements and trade negotiations. Major stock indices such as the Dow Jones Industrial Average and the Nasdaq Composite experienced notable declines. The tariffs introduced a significant degree of uncertainty into the market. Businesses became hesitant to make investment decisions. Consumers became more cautious with their spending. This uncertainty weighed heavily on investor sentiment. The tariffs and the ensuing trade war had a profound impact on investor sentiment. The constant threat of new tariffs and the unpredictable nature of trade negotiations made investors wary. The stock market, often seen as a barometer of investor confidence, reflected this anxiety. The tariffs created a climate of fear and uncertainty in the market. Investors became more risk-averse. This led to a decline in investment activity. The tariffs also raised concerns about the long-term impact on the global economy. These factors contributed to a general sense of unease among investors.